Kia ora koutou, Atamaria, good morning. Welcome to day 2 of the 2024 New Zealand Economics Forum. We've got a full program ahead, and in just a moment or two we will be joined by Adrian Orr, the Governor of the Reserve Bank. Unfortunately, Adrian is unwell and was unable to make it up here last night, so he's going to be joining us on the small screen behind me. So he'll be here in spirit, if not in body, and we'll get into a good conversation with him. For those of you that were here yesterday, a wonderful day. I've chatted to many people over a coffee and rich conversations that, of course, continue once the discussion on stage is finished, which is the point of these discussions. So thanks again to all of our wonderful speakers and facilitators. For those of you that stayed for the dinner last night, a remarkable conversation between two former Prime Ministers, Jim Bolger and Helen Clark, wonderfully led by Josie Pagani, who is available to fill in as Speaker of the House at short notice, having managed dueling Prime Ministers in a way that few can. So the program for this morning, we will hear from Adrian. We will then take a short break. Again, I'm conscious it was a long day yesterday and an early start. At about 8:45, we'll be joined by Treasury Secretary Carolee McLeish. We will then have a panel discussion on fiscal policy, Treasury and the state of the books, which we can think of as dueling economists. There'll be some interesting views there, so I'm looking forward to that. Straight into infrastructure session, another break, and then our last sessions of the forum will be around climate and weather and what happens if we can't curb emissions. Looking out then, finishing on the future note, looking at the fintech sector, a critical and growing sector, before we wrap up just at 1 o'clock. So we have a full program. We'll give you plenty of breaks and plenty of caffeine, and I look forward to another excellent morning. So that's the program. And now, if the technology works, we will see. It does. Greetings, Governor. Can you hear me?
I can, yes, thank you very much.
Kia ora, and before you begin, welcome, thank you again. This is your 4th appearance at the New Zealand Economics Forum at your old university, so good to have you back, and sorry to hear you're unwell, but we're looking forward to your remarks. I will be quiet, and the floor is yours.
Well, kia ora tātou katoa, tēnā koutou katoa, and thank you again, Matt, for having me on the guest list, and apologies everyone there that I can't be in person. It's to your benefit, not mine, in terms of running around being a super spreader. No, it's not COVID, but it's not fun. Enough about me. I do actually want to note that you have some very senior members of Pūtea Matua, the Reserve Bank of New Zealand, in the room with you. In fact, 2 Monetary Policy Committee members, Karen Silk and Paul Conway. So any difficult questions, you can hit them up in the over coffee after the speech. And you're right, I have been back-to-back here at Waikato University, which has been wonderful. And the agenda has always looked really pragmatic, practical, and on topic. So that's great. So I know Carolee will be chatting after me. One of our key tasks that I talk about in the speech is the criticality of the fiscal policy, monetary policy, working in unison together. It sounds simple, it sounds easy, we can see each other across the terrace, but it's always incredibly complex around time horizons, decision making, so on and so forth. But I'm sure Carolee will talk to that. My talk today really is on the recent changes to the Monetary Policy Committee's objectives and how they fit very well with flexible inflation targeting here at Pūtea Matua. And really it's in part reminding people what we've been doing over the last 3 decades, but bringing it into the more recent context of what we have just experienced over the last 3 to 5 years. I'll briefly note some of our other key priorities, and again, Paul and Karen being in the room and potentially some other Reserve Bank staff, do hit them up about some of these priorities because they are all rich and meaningful research areas And we need people focusing on these issues. The agenda actually at the Waikato University does focus on it. We've got technology later on, absolutely critical to what we are talking about. We are a full-service central bank, which is a wonderful thing. Full service. We've got the monetary policy, financial stability, our cash obligations, and of course significant parts of the financial infrastructure that keeps Aotearoa New Zealand operating on real time. So first, I do want to. I know it's early in the morning, and so I apologise for this, but I did just want to kind of set the scene by talking a little bit around the types of inflation that we observe and how they have evolved over time. So I was just going to perhaps put up slide one if we could, please. I don't know if that blanks me out or not, but sorry if it doesn't. But slide one, whether you can read that or not, no, I'm not going to talk to the slide. Monetary policy is tasked with ensuring that we achieve 2% headline inflation on average through time over the medium term. So a key challenge for us as policymakers, and by the way, I'm talking internationally, not just domestically, a key challenge for policymakers is distinguishing between the transitory and the persistent or core inflation pressures that we see in the economy. As the name transitory suggests, of course, they should be temporary. These are generally relative price movements that will work their way out of the system without any particular policy adjustment. Transitory inflation is usually caused by unexpected relative price shocks and will tend to dissipate through time, but they are measured in headline inflation. Meanwhile, the core inflation component, the persistent part, is that inflation that is left behind when these transitory relative price shocks have worked their way out of the economy. So we observe headline, but we are targeting in a large sense core inflation. Core inflation is driven by things like the capacity constraints in an economy, the balance between supply and demand and the prices upwards or downwards on general level of prices. They also obviously get affected by product markets. I mean, labour market dynamics and wage inflation are an incredibly important part of core inflation. And as I mentioned, if they feed into the general price level, then that can become persistent. Expectations of future inflation also feed into core inflation. If inflation is widely expected to be higher in the future, then people think, well, if I'm very confident around my expectations, I will start to change my wage demands or my pricing demands. And if I'm able to pass that through to consumers or some other business, I will do my best to do so. So inflation expectations really can leak into core inflation, and they are a number one challenge around anchoring longer term inflation target. If inflation expectations get away, you have to do an enormous amount of work to re-win your credibility of getting inflation back to your 2% target. So the monetary policy lens, as I said, leans most through the persistent inflation pressures. We want to ensure that headline inflation is always expected to return to our target. Now, so thank you for that motherhood speech on inflation. I now want to just talk about some of the real-time challenges. Measures of core inflation estimate the persistent component. We try to strip out the transitory measures from headline inflation. But our real challenge is that these measures of core inflation can evolve through time. A measure of core inflation now for this quarter, first quarter 2024, will end up being quite different by the time we re-estimate a measure of core inflation for this quarter in a year's time. These are models and frameworks and understanding what is seeping into the bones of that core inflation. So they're prone to revision. We do lots of different ways of dissecting headline inflation to try and get insights into our estimates of core inflation. Often you will hear economists talk about tradables versus non-tradables inflation. And this is our ability to dissect headline inflation, what comes out from Stats New Zealand or whichever jurisdiction you're in, and we can split it into this concept of non-tradable inflation changes. Non-tradables are really about the inflation that is coming from the production within your economy for goods and services, the domestic production, supply constraints and domestic-driven inflation. It can be influenced by these transitory shocks, particularly if transitory shocks are feeding into inflation expectations. But it's mostly about the core domestic-driven inflation. By contrast, and certainly high profile in Aotearoa New Zealand, given our small open economy, tradables inflation are driven by international price movements primarily in product markets, and of course our exchange rate. And these tradable inflations reflect really long-term structural changes globally in any economy. We've had talked about China dividend around lowering the relative price of imported goods, as well as a lot of temporary factors, particularly supply shocks, and you know, I'll come to a few of those in the future, especially around food and energy. So you get these changes from we're after core inflation. We only receive headline inflation. We can dissect it into tradables, non-tradables, and we are trying to look forward to which bits we, with our monetary policy, need to lead into. So to summarise, measures of core inflation help us identify how much of headline inflation is persistent, and while stripping out tradables, non-tradables, it gives us a good sense of where the relative pressures are coming from, domestic, international. That's the way through. Of course, we also draw on a much wider range. We don't just sit there and wait for a single price index and then distort it until we find what we need. We're looking at many other real-time measures of price pressures, such as wage growth, the inflation expectations, anything we can glean to get a sense of what is going on to the underlying core inflation. Now, with that, econ, it's probably 101 now. That would have been 301 when I was at Waikato University, but I'll go back to after that econ 101 discussion. I want to talk about the changing nature of these drivers of inflation over the last 3 or so years. You know, the period between 2020 and 2023 up until now has been incredibly unique around what has been happening, and I'll talk to it via these tradable, non-tradable inflation. So going back to the early 2020s, which I have to say feels like a lifetime ago in some ways, the onset of the COVID-19 virus created this unprecedented global uncertainty for policymakers, all policymakers, monetary policy and fiscal policymakers included. Mostly across the world, policymakers, central banks, private sector economists around the world anticipated a very deep recession, an economic downturn, and potentially deflation, negative inflation. So we're at the beginning of 2020 and no one could really forecast. You could just create scenarios and think around what it was. So faced with these deep recession prospects, monetary and fiscal policy makers, again, almost uniformly globally, provided historical levels of financial support, monetary support, fiscal support, as well as financial market support around making sure our markets could operate, prices could be made, our day-to-day business could continue on. With COVID-19 spreading rapidly, it didn't just suddenly arrive, it arrived and spread. It was having devastating consequences on global economic activity and human health and well-being. And there was only a hope of a vaccine. We have to remember at that stage. So policymakers, Te Pūtea Matua included, leant on the side that it was probably going to be better to choose which mistake you were going to make, whatever it was, because there was no way to predict it perfect. It was better to rather than do too little to maintain economic and social cohesion, we were better leaning on doing too much. And so we were very strident in our monetary easing and financial market operations. And this was absolutely with a short-term view, to retaining, I would say, economic and social cohesion at the time. In New Zealand, I'm moving forward now in time. By early 2021, we've moved forward a year, thanks to the remarkable development of a vaccine and containment, I would say, not eradication of COVID-19, and the strong monetary and fiscal support globally and domestically. The economies were running strong, certainly well above any expectation 1 year earlier. So it was a positive surprise. We were in a position where the vaccine had come, people were moving, the fiscal and monetary responses had worked, and we were in this now in a different decision-making place. With the increasing demand, those people who had retained jobs and incomes, spending was rising. And of course, supply chain challenges remained. So we go away from, we're starting to see some core inflation pressure building up, as well as significant tradable inflation pressure building up, whether temporary or permanent. And so by the mid of 2021, headline inflation had reached 3.3% in Aotearoa, New Zealand. That's above 3.0%, the top of our range. And this meant that we had to be thinking much harder around now, what is the future for containing that? This is where the world split. We didn't sit and wait to work out which side of the world won the debate, but the world, monetary policy debate was around this inflation surge across countries, whether it was transitory, supply shocks, etc., or whether it was now going to be more persistent and really needing a significant monetary policy response. Team transitory had the prevailing view that most inflation was driven by these supply chain bottlenecks, that they would heal very quickly once people were allowed to move again, and that labour supply would bounce back and be available to all as the vaccines were rolled out. So a very strong faith in the relative price movements coming right again once people were allowed to be back out on the streets and travel internationally, so on and so forth. Team persistent. The opposition, I don't know who was wearing red and blue or yellow and green. Team persistent highlighted, the strong domestic economies and tight labour markets. Labour shortages were the number one pain for businesses, not being able to find people. With ongoing robust demand, especially those people who had remained connected to the labour market, falling unemployment because of growing, all pointed to rising core inflation pressures. So when we are looking at what the real-time measures were, our estimates of core inflation in New Zealand had remained reasonably subdued. In fact, I might ask if we could go to figure 1, please. Oh, that's beautiful. Look at that. Figure 1, I cheated. It's actually got 2 graphs. So you can see in that graph there's it's the same thing measured, but one's measured in real time. What can we see with real data moving forward? The other one is measured now looking back. So it gives you the idea of how adaptive measures of core inflation can be. But what you can see there is, even though headline inflation had hit the 3.3%, gone north of the band, core inflation remained pretty subdued in mid-2021. Our models indicating it was at about 2.2, 2.3%, which is, when I last looked, very close to 2, the midpoint of our target. And so that is, that was our signal around the core inflation. But if you move forward, and with the benefit of time and more data, these estimates for the mid-2021 have risen. They rose from around 2.2 to around 3% in the second quarter of 2021. So this is a real challenge around the real-time measures and just how careful and forward-looking you have to be on when setting monetary policy. Of course, we didn't sit there, as I mentioned, and wait for team transitory to out-argue team persistent or vice versa. We got busy. And so, notwithstanding this uncertainty on the degree of which inflation was persistent or transitory, the Monetary Policy Committee signalled very strongly in July that monetary policy had to tighten soon and significantly, and we provided a clear path for that tightening. It commenced eventually in October. It would have started earlier, but we went into yet another variant of COVID. We all got to learn about Delta, and those who lived in the older region got to learn about Delta very personally. Auckland went into a lockdown. So we really just had to wait until, not until the lockdown had removed, but wait until people had resettled themselves, and then we continued the interest rate hike. The uncertainty continued throughout 2021. The vaccine rollout began. We had this new variant of Delta, and then much, I would say, to the chagrin of Team Transitory, global supply chains remain fractured, and these new COVID-19 variants kept ripping through the global population. So it became high headline inflation and rising core inflation. And then, of course, in February 2022, Russia invaded Ukraine, putting unprecedented upward prices on food and energy, feeding into global headline inflation and New Zealand via tradable inflation. So just back-to-back shocks, supply constraints, relative price upward shocks, at the same time as the COVID variants are running through. On the back of the headline inflation expectations also began to increase. And I might, I think we've got another slide there, please. Oh, sorry, that was just looking at that slide. I just need to show you, we didn't muck around. You know, we were first out of the gate by some quite considerable period on the monetary policy, and other countries have reacted in extremely similar paths, and we're all there or thereabouts in the same kind of place now. Financial markets are, of course, now very excited about, does it continue to go up, or or how long does it stay where it is, or when it can go down. But by the way, I won't be talking about that today. In part because we go into our Monetary Policy Committee meeting starting Monday next week, and we'll be talking about it in late February in our statement. On the back of the headline inflation, the inflation expectations, next graph please, began to increase. The New Zealand 1 year ahead inflation expectation is very volatile and probably rationally. It tends to move very closely with actual headline inflation, and you can see that reached 3.7% by late 2021, and then got to just over 5% by the end of 2022, and that is very, very concerning for us. That means that people are starting to think that the consumer price inflation they have or can see in front of them will persist into the future. And those expectations feed, of course, into their pricing decisions, their wage demands, their general behaviour. And this is where the inflation expectations can become self-fulfilling. I expected to go higher, I ask for higher prices, higher wages, I pass on higher costs, and hence inflation goes up, so I expect it to be higher again. And so making sure that inflation expectations don't get baked into our behaviour is the core task for Te Pūtea Matua Reserve Bank. From early 2022, it was only then New Zealand was slowly reopening to the world. Domestic spending remained strong. Unemployment went to record low levels, in large part due to the lack of labour. And when the international borders opened to travel, it was for Kiwis, and that saw a net outflow. We didn't have the net inflow that we were receiving at the moment. Kiwis could travel abroad, some Kiwis came home, but all of it added to wage pressures, ongoing wage pressures. If you're not feeling like you've heard enough shocks yet, I'll just give you one more. In early 2023, and to think it's a year on now, we had those devastating severe storm patterns throughout New Zealand, and in particular Cyclone Gabriel, which destroyed infrastructure, businesses, took lives, and again added to significant supply capacity pressures and infrastructure demand and spending. Throughout all this period, the MPC has continued tightening monetary policy conditions to deliberately reduce inflation by slowing demand and making room for the supply capacity of the economy to catch up. And we had the official cash rate, our monetary policy, at 5.50% by May 2023, where it remains at present. By the end of 2023, I'm pleased to say that headline inflation has declined to 4.7%, still above the 3, but down from a peak of 7.3. But tradables inflation has done a lot of that heavy lifting. This is the international price of goods and services. Tradables inflation has fallen to 3%, well down from its 8.7% peak. So that's come down a lot. And non-tradables inflation is moving in the right direction, but it's moving a lot slower. These are the core persistent domestic components of inflation. And that's only come down by 1 percentage point from its peak of 6.8% in early 2023. So you can see that headline inflation is coming down. The non-tradable inflation is moving, but moving much slower. And a lot component of that is around inflation expectations and domestic price setting behaviour. So all measures for inflation have declined. We're all moving in the right direction, but it's this tail end. 4.7 is more than 2 times 2%, and we've got more work to do to have inflation expectations truly anchored at that 2% level. And this is the part where capacity pressures and inflation expectations are the Monetary Committee's real focus to get done. So how does all that fit in, that beautiful short historical chat? By the way, there's a far longer and more insightful and deep and meaningful document called our review of the financial, the implementation of monetary policy. One of the key authors, Paul Conway, is sitting with you, so challenge him around what he's doing. In terms of where we are now, reflecting on the Reserve Bank's review of monetary policy remit has been really important. We, under our new legislation, are legally obliged every 5 years to stop, look back and say, is this monetary policy remit suitable, working for Aotearoa New Zealand? I'll take away the excitement. Our answer is yes, but we did have recommendations. Since the formal adoption of inflation target in 1990, so a few decades back, there's always been some mechanism mandating monetary policy to focus more on the persistent components of inflation and to discount the transitory volatile shocks to relative prices. We do that to avoid, I suppose, jumping at shadows and leading to highly volatile interest rates, exchange rates, output and employment. Monetary policy works with a lag. We need to focus on the bits we can influence. And we do this to try and make sure that we don't exacerbate booms or busts in the economy. So as has become clear over the decades, the economy, particularly in New Zealand, given our small open nature, faces many temporary price shocks. These, of course, by definition, are unforeseeable. They're caused by factors outside the control of monetary policy, usually outside the control of any New Zealand policy, but they often do revert back quickly. You can think about global energy, global food price rises and falls that we've seen in time. I think there's a graph of that, which the next figure, please. Beautiful. And that really there is just taking the headline CPI inflation, highlighting the food and the energy price components of it, and you can see the variability of those two relative to inflation absent those shocks. So while inflation can be volatile month to month, monetary policy influences with a lag. We're trying to look through or discount some of those near-term price swings, but focus on the second round impacts so they don't get into core inflation. The lag of what we do to the eventual inflation outcome has stayed pretty stable right through this period, which is remarkable. Research we just recently published. It remains about 18 months to 2 years between when we shift the official cash rate to the peak maximum impact on inflation. So it accumulates through time. It hits different parts of the economy at different paces. The exchange rate's almost instantaneous, output's quite quick, but by the time it feeds through into actual headline inflation, it's anywhere between 18 months and 2 years. And by that time, the transitory impacts have largely washed out. So what we're really operating on is looking at the core inflation components. Monetary policy also operates with, significant uncertainty. For example, the impact of monetary policy on inflation can change over time. Key data is also released with a significant lag. That means we are prone to large revisions. We are prone to the use of estimates. I'd highlight the recent revision to New Zealand's GDP, which stretched back over 2 years. And, we're continuously trying to understand which parts of those relate to the supply capability of the economy versus the demand side, the difference being what we need to be concerned about for inflation pressures. So, the simple analogy is when your windscreen is filthy, it's very hard to see where the next turn is. You tend to want to be cautious and not jumping at every possible sign of a turn. These realities make achieving 2% inflation target with precision today or on any specific date impossible. I won't say difficult, I'll say impossible. One, you don't want to be able to do it because relative price shocks are critically important and we don't have any influence or control over them. And two, if you were trying to do that, you would be putting the economy through ridiculous uncertainty, volatility, variability, and you still wouldn't succeed. That is a real challenge. So we're saying credible, forward-looking inflation targeting still provides the best well-being, welfare to New Zealand. It allows for a more considered response to noisy data and the focus on the balance between supply and demand and the role of inflation expectations. It has to be a credible forward-looking. If I just keep saying, yeah, mate, one day we'll get there, that's probably not going to work. We actually have to win the hearts and minds and be trusted by the public that we are focused on achieving 2% inflation. So while the medium-term concept doesn't provide a specific date, we have a lot of tools and communications and economic science behind how we try to earn and retain the trust of the public. Right throughout the COVID-19 period, for example, we always had a monetary policy statement which provided our best foot forward, our indicator on where interest rates would need to be, monetary policy, to achieve 2% inflation target. Between monetary policy statements, as new shocks and activities happen or we glean more information around how the economy is behaving, evolving, we would change that interest rate reaction function to continue to hit the 2% inflation target within our forecast period. Again, that 18 months to 2 year ahead forecast period. We provide a lot of words, examples, and access to our data and information and research to earn the confidence and enable broader communicators, the market, the private sector to understand, debate, and effectively price where they think we need to be, whether we've got it right or wrong, to achieve our target. The number one thing that we are always concerned about is people would lose confidence that we are aiming at that 2% with real vim and vigour. So that's the 2%. What does all this mean? Well, it means that there's no single at any point and consistent through time optimal time horizon or path for interest rates to achieve that 2%. Fortunately, it's a repeat game, a reset game, but the discipline is to make sure people always know what we're aiming at with confidence and trust. How we might react to different relative price shocks in between will also depend on the state of the economy at any particular time. This has been really relevant recently. We may be very confident to look through a transitory price shock if inflation is extremely low and inflation expectations are well below the midpoint. That was a lot of the story during the 2010s. Global prices falling, inflation, headline inflation globally heading below the midpoints of inflation targets, inflation expectations continuing to decline. We had that benign period, we had the China dividend, and looking through temporary price shocks was much easier. You had more confidence that it wasn't going to feed into generalised inflation. Of course, if you're sitting in a period of high inflation and rising inflation expectations, our ability or our appetite to be able to look through temporary price shocks is significantly reduced. And that has been the case over recent quarters, as explained, when you've got rising headline, you've got persistent core, and you've got inflation expectations creeping up. It is a very uncomfortable position for a central bank. And so central banks around the world have been trying to explain this ad nauseum to the public, that whilst inflation is coming down, we are not there yet. And the last few yards may be very difficult because we really need to re-anchor that 2% inflation expectation. So in our advice, when we sent it to the previous Minister of Finance, our advice on the remit, we recommended amending the remit to really clarify the primacy of the inflation target over and above. So it was to achieve low and stable inflation whilst supporting maximum sustainable employment. Achieve support. There's already implicit primacy there, but it came into common jargon, dual targets, etc. No, there's a primacy involved. Can you please highlight that even more? And that was largely around the inflation expectations that are going on. Sorry. Our mandated review, however, we didn't explore whether maximum sustainable employment should be dropped completely from the remit. We didn't explore that because that's not our role. That is a legitimate role of the government of the day, the legislative matter, and you've seen that the maximum sustainable employment in our new remit, while the labour market is still discussed, it's no longer sitting there as a support objective. It is a secondary consideration. So whilst we didn't recommend that, we didn't recommend it because it wasn't within our rohi. And of course, we had been able to manage incredibly well with that remit at any case. On that front, while the removal of that MSC objective does provide some benefits for clarifying the Monetary Policies Committee's objectives, it does not mean in any sense a significant change to our task, the Monetary Policy Committee's task. The labour market is such a key driver of economic activity and inflation that we have to be well versed, well understood around the capacity, the capability, the workings of the labour market to understand the supply capacity of our economy, people, skills, and also the wage impacts on core inflation. If wages are rising purely because of higher expected inflation, as opposed to because of higher productivity, then that's an inflation challenge we have, rather than a fantastic real-world challenge of having a highly productive labour force growing in real incomes. So these are the challenges. We remain with a large research agenda and a considerable conversation now and forever around the labour market. I'll just shift now really away from that to estimates of the optimal inflation target. And these, it's kind of interesting, if inflation is bad, why don't we target zero? And if life was just that simple, estimates of the optimal inflation target that best balances the costs of inflation versus the benefits of small inflation is a really, really important part of what we're doing. The costs when we talk about it. There are the distortionary impacts of inflation on the tax system. It has incredible impacts and interactions with the asset markets, especially the housing market in New Zealand. That's a whole other conference topic itself. And the relative price distortions within the market. People find it much harder to work out, is that general inflation or is that a relative price because that's a better product? And so all of those arguments support a very low rate of inflation. Supporting a slightly higher rate of inflation are concepts like greasing the wheels of the labour market. This is a really important one. It is easier for people to accept or receive a real wage decline or real wage increase through time without having to go and negotiate a nominal wage decline or a nominal wage increase. And so the ability to have some inflation to allow real prices to move can reduce friction in an economy. And of course, the ability to weather some of the price shocks. If you're aiming at zero, what are you doing when it's negative, positive, so on and so forth? So those, I'll just finish with one more contemporary issue around what would be an optimal inflation rate. And that really is when we entered the COVID period, the number one concern globally was deflation or very low inflation, meaning we are hitting the effective lower bound on nominal interest rates. The central banks can only go so far in reducing the interest rates. What are alternative ways of providing sufficient stimulus to continue to provide monetary policy services? Negative interest rates, quantitative easing, so on and so forth. That was a number one concern. The good news is with some small but positive inflation, you're less likely to be in those discussion zones at the time. I remember issuing a paper in third quarter 2019 around us opening up that whole conversation with the market and talking about negative interest rate capability, being ready, quantitative tools, etc. It sounded like a theoretical discussion. 4 months later, it was a very practical discussion. So where are we at? Well, from all the work we've been doing, all the ups and downs, and in the remit, we think that a 2% midpoint target is well in the zone of an optimal level of inflation. We don't see any particular strong reason to do that. And that has also come through in our new remit. I don't know to take this as comfort or consensus, but there's a slide. There we go. It's already up there. We are not alone. 2% is the midpoint across many countries. Some have ranges between 1, 3, 0 to 2, but you can see the magic number 2 is the red dot point across most countries. So that's it. What have I traversed? I've traversed the challenge around understanding core inflation, the fact that it can move through time based on inflation expectations and domestic demand pressures, the fact that it's not measured in real time and we have to estimate forward and it will change through time. And all of those feed into why we have a strong desire to retain a forward-looking, credible inflation targeting regime for New Zealand. I will finish up very briefly. Whilst getting inflation back to 2% is our number one challenge at this present time for the Reserve Bank, or the Monetary Policy Committee. We've got a lot else on, and a lot else on, covers from the monetary policy stories, the research that's come out of the RAFIN work, financial stability, the cash operations, and financial market infrastructure. We need your help. I called for that last year as well. A few of the areas we are working very closely with now, and Carolee may talk about it, is how we can better coordinate monetary and fiscal policy. Sounds simple. Monetary policy can react to whatever we're seeing. Fiscal policy has very different entry points, very different leads and lags, and it's decided by people other than Treasury. It's decided by Parliament on what happens when, how, where. So it sounds a nice, simple thing. It has evaded most developed economies since modern economic times. We're also enhancing our capability to support financial markets during dysfunction. We did, I think, 20 years of innovation in 20 months during the COVID period, and we're making sure the lessons are learnt, the instruments are optimal, and we can redeploy them as and when needed in the future, including a better capital buffer and and more foreign exchange reserves. That work will be coming out soon. We've got a massive task of landing our new Deposit Takers Act, and with that, a deposit compensation scheme. This is the scheme that if your bank fails, each person is good for up to $100,000 per individual, per bank, as compensation to keep the economy moving while the bank resolution is operating underway. It'll be a single coherent place. We'll have to have proportionality around regulation for different scales institutions, depending on how impactful you can be. It's simple, not easy, and we're well down the path of that. We hope to have the deposit compensation scheme. We'll have the back of it broken by late this year, but implementation is being talked about in mid-25. We're also looking around the final landing of a debt-to-income ratio. Sorry, too many acronyms. That's the DTI. The debt-to-income ratios is for both households and investors, and really it's about having some management over the probability of default for people taking on excess debt. It will be a complement to, not a substitute for, our loan-to-value ratio. I think if you think about the debt-to-income probability of default, the loan-to-value ratio, loss given default. And we can become more efficient in our regulation by not using one instrument to try and fix another problem. So that is now out for final consultation in the public arena. We'll be publishing our climate change stress tests, which are significant. I'm pleased to say no one argues, why do you bother doing this anymore? The insurance sector is extremely challenged. But it's not just them, it's government policy, local government policy, the industry itself around pricing, resilience, capital levels. So we are doing an enormous amount of work, in part how we to coordinate, but also make sure we have cover and robustness for this. Multi-year, again, critical to the coordination. I'm really pleased to just talk about, we've been doing a lot of work around innovation, cross-government work with Treasury, in particular, iwi and the private sector banks and broader government around improving Māori access to capital. This is about unleashing their economic potential. There are specific market failures and specific historical challenges that we are focused very much on. A simple market failure is collectively owned land looks too complicated to provide a loan to. We're working with the Māori Land Court at the moment just to clarify what you can do. And banks are waking up at the wheel, and we've seen a couple of great examples recently. Without any change to policy, they are able to find ways in which they can provide capital to whenua Māori and unleash business. So that's a wonderful thing. But data is a big drive, cultural capability, capacity across both sides, understanding each other's needs, providing simple guidelines and behaviours has been a fantastic move, and it's happening. Part of that, of course, is sponsored by our Future of Money program. We're going to be a less cash, not cashless economy. Cash will have its role. You saw in Cyclone Gabriel 2023, within 48 hours, if people don't have a means of exchange, social cohesion collapses, and that's what happened. We are put the pānui out. We've got small communities who have been effectively debanked or decashed at least, how they can work with us on a program of looking for more efficient methods, more effective methods of making sure cash circulates in the economy. And we're adding to that by being very advanced now around what a central bank digital currency would look like. So it's central bank money as opposed to private money that can arrive digitally rather than in the form of a note and coin. So that's been a big effort. So that's a long, wide range. I'll probably upset half my staff by not mentioning the other excellent things they're doing. And I think I will finish there. Thank you very much. If there's any time, happy to deflect questions. Kia ora.
Kia ora, Adrian. Let's put our hands together. All right, we are tight on time, so I'm going to ask you a couple of questions, but I'll keep them brief. But many questions came through over the app. So first one, and it's a double barrel. When you first spoke to the Economics Forum 3 years ago, we had a discussion. The OCR was at 0.25. We were looking at the recent paper, Navigating at Low Altitude. Remarkable how fast that's come up, and we saw it on the graph before. Two things come off that. One, obviously, and you've highlighted this, it takes time for some of those conditions to be translated into the market. We've got people rolling off fixed mortgages, either at home or businesses and so on. So loans are coming up. The question there is, are you worried about overshoot now because of the lag effect? The second is, what's your take, and are you worried about the whiplash effect on households, say, ordinary Kiwis who went out, borrowed, might have bought at a peak, and the impact at a household level of people who are encouraged to borrow, they might be feeling pretty high and dry now. What's your take on those two, given the speed of change?
Yes, thank you, and great questions. And yes, we are worried. So, it is a key focus of both the Monetary Policy Committee, but we also work closely with our Financial Stability Committee. That's one of the benefits of being, the full service bank. Our Financial Stability Report, I really would encourage people to read that, because we talk very explicitly around what the levels of stress are in households as well as in the financial institutions themselves. On the second one, on the financial institutions, non-performing loans are rising. They're rising slowly, but they are still at a historically low level. And when we look at and do our best efforts to kind of project ahead of where they could get to, they remain very manageable for the financial institutions themselves, the large mortgage lenders. For households, we are 3/4 of the way through, I think, the monetary policy impact. I think the effective, the team there can, so I think we will have a peak effective retail interest rate of about 6.4%, on the top of my head, by mid this year. And we're 80% of the way there now. So that's as people roll off and then roll on to whichever tenor they choose. So they're 3/4 of the way through that. The banks themselves, the information we're getting is that people are managing, and a lot of the growth in non-performing loans, etc., has been due to idiosyncratic shocks to those particular households. That's a nice way of saying if someone becomes unemployed. And so it's the unemployment, it's the labour market that will create the most significant stress on the ability to service a loan. It hasn't been so much the price of the loan. Yes, households are being squeezed. Yes, some significant trade-offs are having to be made in houses, but the real risk, of course, is being employed. So, from a financial stability side, we're saying we're in, good space. And in the household side, we're saying stay close to your bank. Stay close and make sure they're working with it. There is one specific cohort of lending that happened over a 6-month period where they hit the lowest interest rate, and fortunately we had the loan to value ratio still there, but took on the most debt. And so that cohort is, it's narrow, but the broader on aggregate, it is very manageable.
Look, it's hard to pull back because we've got so many questions, but I'm conscious we've got to keep moving for the rest of the day, and we're about to go into the Treasury discussion with Carolee. So look, I will have to wrap it up there. Again, Governor, thank you for participating, even if not in person. We wish you and the team good luck. We wish Paul and Karen good luck answering all the questions that have come through on Slido over the coffee we're about to have. And we'll look forward to hopefully seeing you again next year. Thanks again.
Kia ora. All the very best wishes to everyone in the room, and apologies again for not coming up and spreading my illness.
Great stuff. All right. Thanks, Adrian. Cheers.
Thank you.
All right. For those here in the room, we will now have a 10-minute break. So